Welcome, everybody, to this emergency COVID-19 tax update. My name is Jonathan Kolinsky. I'm the chair of the tax section of the Beverly Hills Bar Association. I'm a partner at Hochman, Salkin, Toscher, and Perez here in Beverly Hills. I say here in Beverly Hills. Usually we're at the bar. I'm in Los Angeles technically now. We hope everybody is safe. Keeping their social distance, washing their hands, not touching their face, and making sure that they're doing their part. I want to thank our panelists for putting this together very quickly. I'll just give a quick introduction and then let the panelists go right into it. We have Robert Horwitz. Robert's a partner at Hochman, Salkin, Toscher, Perez. Cory Stigile. Cory is also a partner at Hochman, Salkin, and Gary Slavett. Gary is a partner at Holtz, Slavett, and Drabkin. All of us are in Los Angeles. Our offices are in Beverly Hills. Without further ado, I will turn it over to the panelists.
Hello. Well, thank you for joining us all. I think we're all in a unique situation. For myself, we were in the middle of doing construction on our house, so I'm in a 2-bedroom rental house. And my wife has taken over. She put her office in our bedroom, so I set up in the kitchen. But for this talk, I'm in my kids' room. So you know, we're all doing what we can. I guess Cory, about a little what's going on with you?
Okay, yeah, we're here in our house as well, and staying isolated here in the house. And I'm here in my, I don't know if you could see it behind me, but you got the exercise bike back there, if I go that way. But we're doing our best and taking turns with my wife with the kids, and we're so doing our best here too.
Robert, you want to say anything?
I'm in my office.
All right, so kind of real quick to kind of set the framework, you know, we've been hearing a lot about all these different legislative actions by Congress, the president, and the administrative branch. And really kind of a quick overview before we get into the details. What we're calling COVID-1 was passed on March 6th, and that was the Coronavirus Preparedness and Response Supplemental Appropriations Act. And that was early on in this epidemic and in the pandemic, excuse me, and it was about $8.3 billion of funding for federal agencies. The COVID-1 we're not really going to discuss because that had to do with emergency funding for the different agencies. COVID-2, which is the Family's First Coronavirus Response Act, came out in March, or was signed in March 18th, and that does have some interesting things for employers and individuals. In that one, it talked a lot about paid sick leave and family leave and different tax credits that employers could get. That also had the free coronavirus testing, expanded food assistance and unemployment, and some protections for healthcare workers. And then COVID-3, which came out on March 27th, which we call the CARES Act, was basically the big one. It was $2 trillion relief package for state and local governments, big businesses, small businesses, healthcare providers, individuals. And so we have really COVID-1, COVID-2, COVID-3. And in addition to that, the agencies have taken actions, you know, to assist taxpayers as well. And so we'll be talking about the IRS actions, and we'll be talking about the state of California agencies actions, the FTB, EDD, CDTFA. And the topics we're going to be discussing are going to be the employment tax provisions that are in the Families First Act, as well as in the CARES Act. We're going to be talking about also the retention credit, the deferral credit. Those are really the employment tax provisions, and Robert's going to be covering those. We're then going to be talking about the small business loan programs, which are really the PPP, the Payroll Protection Program, and the Emergency Income Disaster Loan Program. I'm going to be talking about those. Cory's going to be talking about some of the business provisions on the NOL provisions. We're also going to be talking about the change to the interest limitations and the qualified improvement property change. And then we're going to be talking about some individual provisions with retirement plans, charitable contributions, employer-paid student loans, and then we're going to go into the actions of the agencies. So we got a lot to cover. We'll do the best we can. Each one of these probably can be its own topic and its own panel. So we're going to do the best we can, and I speak fast naturally, so I hope you can keep up with me. And I guess Robert's going next.
I'm next. I'm going to first cover the employment tax aspects of the Families First Act. As part of the Families First Act, which was enacted on March 18th, 2020, employers are entitled to a credit against the FICA employer portion, or the Railroad Retirement Tax Act employer's portion, for paid sick leave and paid family leave. Now then, Section E of the Act determines what is paid sick leave required under the Act. And there are 6 types of situation in which some employer is required to pay sick leave, and this provision apply to employers of 500 or fewer employees. First are employees who are subject to a federal, state, or local quarantine or isolation order due to COVID-19. The second type of situation is where an employee has been advised by a healthcare provider to self-isolate due to COVID-19. And the third situation is where an employee has symptoms of COVID-19 and is seeking a medical diagnosis. And the first 3 I'll refer to as the personal reasons. Now, the 4th, 5th, and 6th are first where the employee is caring for a son or daughter who is unable to go to school or healthcare facility because those are closed due to COVID-19, or the child care provider is unavailable due to COVID-19. The second is where the employee is caring for a person who is subject to a quarantine or isolation order, or has been advised to self-isolate by a health provider. And the final situation is where the employee is experiencing what is called a substantially similar condition specified by the Secretary of Health and Human Services. And the final 3 I'll refer to as the non-personal sick leave.
Now, Robert?
Yes.
Robert, we're getting some indication that there may be some feedback on your microphone. Do you have your do you have your cell phone on as well as your computer, or just your computer?
No, I just have my computer on.
All right, I guess we'll have to, there's a little bit of feedback. I don't know what it is, but we'll do our best. Keep going. We can understand everything now.
Okay. Well, for purposes of the paid sick leave, a employer is entitled to credits for paid sick leave of up to 10 days. And the credit is against the employer's share of FICA or Railroad Retirement Tax Act taxes. And if the sick leave is due to what I refer to as personal reasons, the amount of the credit is the amount of wages paid to the employee up to a cap of $511 a day for 10 days per employee. And if it is for non-personal reasons, the maximum amount of credit that the employer is entitled to is 2/3 of the employee's pay capped at $200 a day. And this is also for a maximum of 10 days. So if an employee is out sick due to one of the personal reasons, the employer can get a credit up to $5,110 for 10 days. And if he's out for the non-personal reasons in the Act, the employer can get up to $2,000 for the employee for 10 days. Now then, these credits under the Act are basically taken against the employer's portion of FICA, and the employer is entitled to a refund to the extent the credits exceed the employer's portion of FICA for the quarter. The other portion of the Act is for family emergency leave, and this is for an employee who is off of work because they're caring for a child, their child who is unable to attend, who is not attending school or daycare because the care facility or school is closed due to COVID-19, or where the child care provider is unavailable due to COVID-19, and the maximum amount per day is 2/3 of the employee's regular pay, up to $200. And unlike the sick leave portion, which is capped at 10 days, this is capped at 10 weeks. So if an employer can get up to a maximum of $10,000 of credits per employee for emergency family leave. Now then, there are also provisions in the Act that allow self-employed individuals to get credits if they are unable to work due to any of the sick reasons, or are unable to work because they're home caring for a child. And these again are similar to the amounts of employees. It would be the amount of the person's normal daily self-employment income for the prior year divided by 260, and then capped at $511 a day for the first 3 reasons of sick leave, and capped at $200 a day for the non-personal reasons for sick leave or the emergency child care. And the credits, to the extent they exceed the employer's share of FICA or Railroad Retirement Act taxes, are refundable to the employer. Now then, on March 20th, 2 days after the Act, the IRS issued Notice 2020-57 and setting out the parameters of sick leave and emergency child care leave, family leave under the Act. And rather than requiring an employer to file a refund claim after they pay the tax, the employer can get a credit against all payroll taxes, including income withholding tax. And if the amount of the paid sick leave or emergency family care leave exceeds the total amount of the employer's payroll taxes and income withholding taxes for the quarter, the employer can apply for an emergency refund, and the IRS has issued a form 7200, which the employer would file with the IRS, and the IRS would attempt to get a refund out to the employer within approximately 2 weeks. Now then, for the emergency family care portion of the Act, if an employer has 50 or fewer employees, they can seek to be exempted from the off if they can show that complying with the Act would cause undue hardship. Now then, after that, the IRS has the start date for these credit provisions are a date determined by the Secretary of Treasury and go through the end of 2020. The Secretary determined that April 1st will be the start date, so that any sick leave or paid emergency family leave after April 1st would be eligible for the credit, or beginning on or after April 1st and through December 31st of this year would be eligible for the credit. Then the Congress enacted CARES Act, which provides additional provision for employment tax relief. The first provision is the employee retention credit, and that would apply to any employer, no matter what size. And if the employer has over 100 employees, the employer is carrying on a trade or business is eligible for the credit in one of two circumstances. First, if in any calendar quarter its business operations are totally or partially suspended due to orders of a governmental entity limiting commerce, travel, or group meetings due to COVID-19. A second reason is that the gross receipts during the calendar quarter are less than 50% of the gross receipts for the same quarterly calendar of the preceding year. And the continues through the quarter in which gross receipts are greater than 80% of the gross receipts of the same calendar quarter for the prior year. So if in the second quarter of 2020, the taxpayers' gross receipts are less than 50% of the gross receipts in the second quarter of 2020, and during the third quarter, they go up to 85% of the gross receipts for the third calendar quarter of 2019, the employer is eligible for the employee retention credits for those two quarters. And for purposes of the credit, the employer is equal to credit equal to 50% of what are called qualified wages for the calendar quarter, and the credit is reduced by the amount of credits under the First Families Coronavirus Response Act. And credits in the amount of tax the employer would owe are refunded, but the IRS in Notice 2020-61 provides that the employer can offset the credit against the employment taxes and income withholding taxes due for that calendar quarter. The employer who has more than 100 full-time employees. In 2019, the credit is limited only to amounts paid employees who are not providing services either because of a suspension of business or a drop in gross receipts. And if an employer has 100 or fewer employees on average in 2019, the credit is for all wages paid to employees. And for purposes of the employee retention credit, employers are aggregated together if they are treated as one employer under sections 52 or 414 of the Internal Revenue Code. They're either a controlled group of corporations, a commonly controlled group of businesses, an affiliated group, or certain management companies. This is different than the aggregation rules applicable to the credits under the First Families Act, where aggregation is determined under the Fair Labor Standard Act for aggregating businesses. And the maximum amount of the credit per employee that can be claimed is $10,000. And so employers who qualify for the credit will first be able to offset the credit against their FICA tax after taking into account amounts of credits under the First Families Act. And to the extent they exceed that, they can take the credit against other employment and income withholding taxes. And then to the extent the amount of credit exceed the payroll tax liability for the quarter, they can get a refund by filing Form 7200. And both the credit under the First Families Act and the credits under the Employee Retention Act provisions of the CARES Act have provisions that the failure to deposit penalty will be waived if the reason for the failure to deposit was the anticipation of the credit allowed under either of the act. Now then, there are also deferral provisions for employer payroll taxes under the CARES Act. Under the CARES Act, an employer can defer payment of the employer's share of FICA for 2020, and the payments would be due 50% in 2021 and the remainder in 2022. And for both the CARES Act and the First Families Act employment tax credits, Treasury is supposed to transfer to the Social Security Trust Fund the amount of FICA and Railroad Retirement Act taxes that are not paid as a result of credits or deferrals under these acts. And that basically covers the employment tax provisions of both acts. Gary, do you want to discuss how the employer retention credit and the deferral provisions relate to the payroll PPP loans.
Yeah, I mean, I think we should talk about the PPP loans, and with respect to the payroll retention credit, I don't think you can do both. But I think we'll explain a little bit about the PPP. I don't know, there's some questions from people. I don't know if you can see, Robert, there's on the bottom, there's a Q&A. Maybe I can read them to you if you.
Let me see it.
I'll read, one of them is from Daniel Fong. It says, how do you prove undue hardship to comply with the sick leave, and how do you apply for the hardship waiver? You see those questions?
I don't believe the IRS has issued guidance on how to apply for the undue hardship. The Act itself doesn't state what an employer has to show to apply with the undue hardship provisions and get an exception for the Act.
And another question from Michelle Weiss, do you know if the employment tax credit for sick pay applies to domestic employees?
It shouldn't, because it's basically credits for businesses. So if it's not a business or a exempt organization, but just someone who has a person who has a individual household employee, a maid, or someone in that position, then they're not employees of a business, and the credit should not apply.
All right, I think we'll talk a little bit about, now we'll go into the payroll protection program, the PPP. I'll be talking about that. And I do know that I saw somewhere that the PPP payroll protection program does not apply for domestic employees, for individuals that employ domestic employees. Something else, Robert?
Yes. Okay, I had trouble hearing you.
Oh, I'm sorry. Is there
a lot of feedback.
I'm going to go into the payroll protection program right now. Is there anything else to follow up on the employee credit issue? Nope.
No.
Okay.
But there was one question about foreign corporations with U.S. employees, and although a non-resident alien who gets leave would not be included among employees for whom sick leave wages are taken into account in computing the employer's credit. A foreign corporation that does business in the United States and has U.S. employees should be eligible for the credits, since they would be paying payroll taxes and filing forms 941.
Okay, I think we may have some more questions, but we'll come back to those so we can keep moving forward. We got a lot to cover. So on the payroll protection program, that's part of COVID-3 or CARES, which CARES, I'm sure you all know, it stands for the Coronavirus Aid, Relief, and Economic Protection. So they always figure out a way to have good acronyms, and they got one here, CARES. And Section 1102 of the Act, the CARES Act, or also referred to as COVID-3, is this big payroll protection program. And I'm sure there's a lot of you probably already know a lot about this. I'll try to go through the obvious quickly. I think I have a little bit of some information, although information is coming every day. More Q&As were issued, I think, yesterday or 2 nights ago. And part of it is that $349 billion has been given to support small businesses and to facilitate their ability to retain employees. I did read somewhere that I think yesterday, the Treasury requested an additional $250 billion. And I think that should be helpful because we're all fearful that the money's going to run out, as it likely will. And I'll talk a little bit about the problems that the banks are having, which I'm sure many of you have experienced. But the best part of these loans, if you don't know already, is it's forgivable. That's a big deal. Free money if it's done right, and if you can get it. I'm hoping we can, I can get it for my clients. I'm hoping I can get it for my business. Who's eligible? Generally, it's for businesses with 500 or fewer employees. There are, as with anything else in the tax code, and by the way, this CARES Act is 880 some odd pages, okay? So we're all digesting it. We're all trying to figure it out. Treasury is trying to give us guidance. SBA is trying to give us guidance. This payroll protection program, or the PPP, as we refer to it, is really administrated through the Small Business Administration. So it doesn't directly have a whole lot to do with the IRS or the taxing authority. Obviously, it's Treasury and the SBA that are issuing the guidance on this. And there are exceptions to the 500 employees, right? There's exceptions if you're a larger employer and you receive Medicaid funds. There's exceptions in the hospitality industry. There's exceptions for franchises and multiple locations. So look that up. One of your clients may qualify, even if they have more than 500. They may fall under one of these exceptions. And unlike the employee credits and those other things that Robert talked about, you don't really need to show hardship. But you do have to certify, which I think every business can, that the current economic conditions make the loan necessary to support the ongoing operations of the borrower. Now, maybe that's not true with grocery stores and Amazon, or maybe, but for most part, most businesses are having economic conditions that are not favorable to them. Also, the borrower is going to need to certify that the funds will be used to retain workers and maintain payroll, or make mortgage payments or lease payments, and we'll talk about, and utility payments are under there. And the borrower must certify they haven't received another SBA type loan under Section 7A for the same purposes. So when does the program begin, or when did it begin? It was supposed to begin, or it did begin, on Friday, April 3rd. That was when businesses, other than, I believe, sole proprietorships and independent contractors, who can also qualify for this, are able to start applying. Independent contractors are going to be April 10th. The problem is on Friday, April 3rd, the banks were not ready. There was not much guidance from Treasury. Guidance came out, these final interim rules came out, I believe, 3 o'clock Eastern time on Thursday, April 2nd. So the banks were scrambling. They're not ready. There was press on this from Manouche, from Treasury Secretary, that we would all be able to go to any SBA bank and apply for these loans, and most banks are SBA banks. In practice and practicality, that is not what's happening, or what I'm seeing out here in Los Angeles. Since the banks are scrambling, the banks are only taking, from what I understand, there may be some exceptions, they're only taking current customers. And the banks are concerned about know your client rules and regulations, and about fraud, and about the Treasury coming in and the regulators coming in a year from now and questioning loans they gave out, since they won't be seeing many of these individuals or taxpayers in person due to the stay-at-home orders from the states. So the banks seem to be saying we're only going to take current customers. Well, and then there's banks like Wells Fargo who were saying, we've had past issues with regulators. We're concerned about this stuff. We don't know if there's enough money for us. We're going to limit it. We're limited either through regulation or their own doing to $10 billion of loans. That's not very many. Wells Fargo is one of the largest banks. They by Saturday, April 4th, they were taking not even applications, kind of requests to participate. And by the end of Saturday, they claimed that they received enough interest to exceed their $10 billion, that they're cutting this off, no more requests. Well, that makes it very difficult for Wells Fargo customers who didn't get in there. It's very difficult to go to other banks because other banks are only taking current customers. That may change. I know some people that are going to open accounts at some smaller banks. Those smaller banks are telling them, if you open an account with us, we will try to service you. It's yet to be seen if that's a bait and switch to get more accounts. But from what I can see, it's a big mess. There has been the guidance that came out that Thursday night was very helpful. There was also some Q&As that just came out, I believe, yesterday that answered some of the questions as well. But I still have yet to see anybody actually receive any money from this. And so we'll see how it goes. We'll see, if the money's there. And I was encouraged to hear that they asked for another $250 billion. And so the deadline for applying for this is June 30th, 2020, but the money may run out. I think it'll run out. And so everybody's rushed to get in there. The loan amount, how much could you get, right? 2.5 times your average total monthly payroll costs, capped at $10 million. That's not going to affect a lot. That $10 million cap isn't going to hit a lot of people. And what is payroll costs, right? Payroll costs are salaries, wages, commissions, vacation pay, family medical leave, group health insurance, state and local taxes. And there is a cap at $100,000. So any compensation per employee, about any employee that's over $100,000 on an annualized basis, that's the cap for that employee. So anything above 100, you can't include in your payroll costs. Well, there's been some questions when it first came out about, is it the $100,000 and then can you add the employee benefits like the employer's side of health insurance and the employer 401k match for that $100,000 limit? Can you go above it? So if you have a $100,000 limit, can you add another $15,000, $20,000 for state payroll costs, for employee benefits, and the like? I was on a ABA tax webinar last week, and on that webinar was a tax counsel for the Senate Finance Committee who was involved in writing this, as well as Michael Desmond, I think, the chief counsel, and some other individuals. And the woman from the Senate Tax Committee was very adamant that the $100,000 was the cap, no more. You can't add employee benefits to that. Well, in the Q&A that Treasury issued yesterday, that does not seem to be the case. So the $100,000 is the cap for salaries, commission, compensation, but you can add on to that employer contribution to retirement plans, health insurance premiums, payment of state and local taxes. And that's in FAQ number 7 of this, I believe it was issued yesterday, April 7th, a guidance from Treasury. So this seems to be a moving, some moving issues here from what I heard last week directly from some government people to what they issued yesterday. So you can see they're trying to figure it out. And there was also some issues with respect to payroll costs and whether you can count independent contractors in your payroll costs, because the code was a little bit confused. The provisions were a little bit confusing on that. But that too was clarified, that independent contractors, and that was in the interim final rules issued last week. Independent contractors cannot be included in a business's payroll costs. The reason for that is independent contractors and self-employed people can apply for it themselves. And I think that's where the confusion comes about, where they say, well, this applies to independent contractors, 1099 self-employment individuals, and it does. They can apply for it themselves, but a business employer cannot include those payments in their payroll costs. Okay, and what period of time do you look at to determine your payroll costs? There's a couple of options. You can go back 12 months from when the loan is being originated, which is, I believe, now back 12 months. Or to make it easy for everybody, you can look at your 2019 payroll costs, which I think a lot of people are doing, unless there were some major changes. There are rules for seasonal employers. I'm not going to get into the minutia of that, but if you have some seasonal employers as clients, there's different look-back periods and things that can be done, hopefully to assist them. How do you use the funds? Well, you have to use the funds for payroll costs, group health care benefits, interest on any mortgage obligations, rent, utilities, and interest on any debt that was in effect on February 15, 2020 or before. What's the term of the loan? hopefully it's forgiven and it's done correctly, but if it's not forgiven, it's 1% interest. I believe the payments are deferred for 6 to 12 months. The loan is due in 2 years, and there's no collateral and no personal guarantee. That's really a big plus for everybody, for all our clients. And the biggest plus is the loan will be forgiven if it's used for its intended purpose. There was some clarity on that in, I believe it was in the final rules that talk about 75% of the funds must be used for payroll. Only 25% can be used for non-payroll. Also, if you reduce, the point of this is to keep people employed and on the payroll. If you reduce your payroll, your full-time employees, your FTEs, the forgiveness may be reduced based on the reduction. However, I believe you can hire everybody back. If you hire everybody back by June 30th and get them back to the same payroll level, you'll be okay. Also, you can't reduce anybody's compensation amount by more than 25%, other than the workers that are over $100,000. You can reduce them to more than 25% to get down to that if you want to. But anybody else, if you reduce more than 25%, it may affect the forgiveness of this. And so, again, the forgiveness will not be automatic. It'll be something you'll have to request from the lender, probably in some form, may or may not be there. I don't think we're there yet. And that's the PPP kind of quickly. I think there may be some questions. We may have to come back. Let's see. There's a lot of questions. Yes, I mean, I think look at the bottom. If you were 1099 and you pay yourself, presumably that is forgivable too. Yes, I don't see why it wouldn't be. As an independent contractor, you're allowed to claim this loan as long as you pay yourself. It can't be more than, remember, $100,000. The payment also to workers can't exceed $100,000 on an annualized basis to be forgiven. So in an independent contractor, 100,000 divided by 12 is 8,333 a month. So as long as you use the loan to pay $8,033 a month for, I guess, 2 months, and you use a little bit, you can use the remaining 25% as well, you should be okay on that. Let's see what else I can answer quickly. Now, I don't think, Marshall asks, is a general partner's share of partnership profits that are subject to self-employment tax included for the wages? That's a good question. As I read it, it's not. I don't see anything that allows us to include that in the payroll cost of the employer. Now, somebody may have a different answer. There may be some more guidance, but I don't see that. They do define payroll costs, and that is not one of the descriptions of somebody who's a general partner and gets flow through on a K-1, but also includes that for self-employment purposes on their tax return. I don't see an answer. I don't believe that's in the payroll cost, but this thing's moving quickly and there may be some changes. It says, do you have a view as to whether the payroll expenses associated with forgiven PPP loan are deductible? Well, clearly the payroll expenses, clearly not the federal taxes. The state taxes are. If not, I'm not sure about, you mean payroll expenses, about you're paying your payroll company and those things? I'm not sure. I don't believe so. I think the definition of payroll costs is compensation and employee benefits, most commonly health insurance and the 401k. And I think there's going to be a pitfall, and we'll see how the banks do these forms. If the bank asks our customers, what is your payroll premium? And they take the whole payroll premium and try to add that in payroll costs. That is not the intent. The intent is the employer portion of the payroll cost and the employer of the health insurance and the employer portion of a 401k match, not the employee part that is deducted from that. But I'm seeing some applications from banks that don't seem to clarify that I see some pitfalls from these banks that may be favorable to our clients if answered just how the bank is asking it. For instance, I saw one that says, what is your monthly health insurance group health insurance premium? Well, if I was going to answer that for my law firm, it would be the total premium that we pay, the employer and employee side. And that is not the intent of this. And I'm sure there's something in there that talks about that, but I think there's going to be a lot of issues like that. Let's see. Somebody asked, David Hunter asked a good question. Should we apply with multiple banks for the PPP loan? I think so, but there was something that I read somewhere about what you must certify when you do these loans. And I think the certification, there was 3 things: that the economic condition makes the loan necessary to support ongoing operations, and that the funds will be used to retain workers. But there's a third one that says you haven't received a similar loan. And I think there's language in there that I don't have it in front of me, that you haven't applied for a loan. Now, I don't know if on an individual basis, if you make that certification, you haven't applied. I guess you have to look at the bank, the first bank you applied to. Are you making that statement anywhere? And if you are, what do you do to the next bank? Maybe you just disclose, hey, I've applied to multiple banks. My intent is not to take more than one, obviously, because that would be clearly fraud and illegal. But applying to more than one bank, you'd have to leave it up to, I would take a look and read about what needs to be certified and kind of tread lightly. But based on what's going on here, I think I would not be opposed to applying at more than one bank, but clearly not taking the loan from more than one bank, for sure. That'll land you in trouble, maybe even in jail. And so I think that's a good question. I think that's probably a practical thing to do. Let's see. I think maybe we should move on. Anybody, Robert or Cory, anything you see that we should answer? Oh, we'll talk about, okay, the EID. There's a question on the EIDL loans. And let me get my notes here. So there's the EIDL loans. There's the economic injury disaster loan, and that's an SBA loan under Section 7B2. And that's been around before this, but the CARES Act made this applicable to the coronavirus issues. And basically, they're loans made up to $2 million, made directly from the Small Business Administration. They're available for working capital and normal business operations. So this is a loan other than the PPP, other than for payroll, but you have to pay it back, okay? And there's all kinds of personal guarantees. There's all kinds of financial disclosures. It's a real deal loan that has a lot more consequences to it. It's the covered period is January 21st or 31st of 2020 through December 31st of 2020. It's a 30-year term at 3.75%. There is no personal guarantee for loans up to $200,000. And part of that, and people who did these, some people jumped online at the SBA before the PPP loans and applied for these EIDLs or economic injury disaster loans because everybody was trying to figure out what was going on. And you can still do that. You can roll it into a PPP. There's different ways to convert them. Read about that. But the best part of the EIDL, which is the emergency injury disaster loan, I know I'm talking fast, that there's a $10,000 grant that is forgiven. It's not required to be repaid. And so what you can do is you can apply for this emergency grant as part of applying for the EIDL loan. They claim it'll take 3 days to get it. I don't know if anybody's gotten it. And it doesn't have to be repaid. And I'm being told, and I've read somewhere, that even if you don't ultimately get approved for the EIDL, you get to keep the $10,000. So everybody should be applying for that, as far as I can tell. And the $10,000, you don't get it. You won't be if you roll into a PPP. The $10,000 will be part of what's forgiven in the PPP loan. So there is some integration. You need to read about that. And the income on these loans will not be the forgiven part of these things. Somebody asked, I think, will not be cancellation of debt income. It won't be taxable on the PPP. I believe that's true with the EIDL grant. But the PPP loan, if you can get it, if you can get the money, if you qualify for it, it's a great thing all the way around. It's one of the best programs out there, assuming we can all get it. And there's regular SBA loans too. There's regular non-SBA loans. I mean, SBA loans that are non-coronavirus based that are still all available for small businesses out there that if your clients don't qualify, you may need to look at those as well. Anything? Cory, Robert, let's see. Just looking through the questions real quick, see if there's something quickly you can answer. All right, we'll try to answer some of these questions offline. We do have them, so we'll go through them and answer them offline. I think we're going to move forward onto some business provisions in the CARES Act. I think that's what's next. Is that right? Let's see. And I'm going to kind of quickly, there's been two issues that I'm going to quickly talk about, then I'm going to hand it over to Cory. One second, I'm just looking at. All right, so there's change to the interest limitation rules, right? Under TCJA, which, you know, surprisingly now is old law, right? Because now we're modifying it with this new law. So already TCJA, we're going to be referring a little bit as some of the old law, which took effect in 18. But under TCJA, beginning in 2018, the business interest expense of many businesses was limited to 30% of what of this new term called adjusted taxable income, or ATI. The CARES Act already is making that a little bit old, and they're saying for 2019 and 2020, the 30% of this ATI, or adjusted taxable income floor, is increased to 50%. So 30 to 50%, that'll allow for a bigger deduction. There's some rules on partnership, so you need to look at that. The 30% is retained, but on the flow through to the partners, they get to claim 50% of it. So if you have some interest from a partnership flow through, you need to look at that. It did modify it, but not in the same exact way. And for 2020, a taxpayer can use their adjusted taxable income of 2019 to determine the 50%. So what does that mean? 2020, everybody's expecting that their ATI will be lower than 2019. And so for the 2020 calculation, you can use the 2019 adjusted taxable income, which we assume will be higher, to get to the 50%. So that'll allow for a little more of an interest deduction for businesses. And another one that I'm going to quickly go over is this qualified improvement property fix. Basically, this is improvements to the interior of non-residential structures and properties. And based on the prior act, there was a lot of confusion, and there needed to be some fixes, everybody felt. And so at long last, qualified improvement properties is given what some call its rightful 15-year life, and becomes 100% bonus eligible. There was, in the prior act, it was 39 years, and everybody knew that was a mistake and knew that wasn't the intent. And I think Treasury said we have no ability to fix it. And somehow they got it in here and they fixed it to move it to a 15-year life of this qualified improvement property. There's some questions on how do you claim it. You know, if you haven't filed your 19, you're okay. If you have, do you do amended returns? Those types of things. And with that, I will turn it over to Cory for NOLs.
Okay, great. Thank you. All right, net operating losses. And I think the place to start here is to start with the Tax Cuts and Jobs Act, because they took away some of the benefits from NOLs, and now they're giving them back and then some. So one thing under the TCJA was the 80% limitation on the NOLs that were being carried forward, or the amount of the income that the NOL could offset. Additionally, there was a rule called the excess business loss rule that limited the amount of those losses that you could take from businesses against other types of income, portfolio income, capital gains, other items. So there were really some limitations on what you could otherwise do with those really nice, juicy business losses. And then over and above that, with having the additional benefits of the accelerated depreciation if you want it, or the interest limitations that Gary just talked about, suddenly you have these potentially supercharged losses. And then there's the question of what to do with them. And so the CARES Act really introduces a complexity that I'll go into with some examples for what you're doing with your losses. First of all, now there's a 5-year carryback that you can utilize with your losses if you have them in a year. And this is in 18 through 20. So this might remind you a little bit about if you experienced some of them of 2008, 2009, during the last economic collapse. There, if you had significant losses, you could carry them back 5 years and generate quite a refund. Even there, though, the losses that you could utilize in those prior years, or at least one of them, was limited to 50% of the income in that year. That limitation's not here. So we're looking at potentially both huge additional losses, or expenses and potentially losses, but also the ability to carry it back, which is making you basically look at 18 through 20, but also 5 years before 2018. So it's really an opportunity to kind of look there and computationally get in there and see what the best steps are going to be. There's some technical things that I won't get into in too much detail with the time we have, one of them being the coordination with Section 965. So if you have that guilty income over the different years, that income wouldn't be part that would offset for the NOL. That's also on that same panel that Gary mentioned earlier. Chief Counsel mentioned there might be some guidance on that coming out. Another area of guidance is to the extent that tentative refund claims could be utilized for these losses for corporations or potentially others. There's potentially guidance coming out on that, and that could be important because when you're dealing with a tentative refund claim, those are supposed to be processed within 45 days. And we know how long it could take for significant losses to work their way through processes. And it just takes a while. So I think they're looking at the extent to which we could do tentative refund claims. So let me just go through a couple examples. One is you get that significant loss now, and let's say it's it could be in 18, 19, or 20, but you're carrying it back. Now you're going to look back at all those prior years. There's going to be an option there on whether and there's some leniency there. When you get into the details, there's some options on whether you want to carry it back, and there's some options if you want to carry it back to particular years where there was the 965 income. So there's going to be some real computational issues here, but potentially some large refunds to get some cash into taxpayers' pockets that experience losses or have those extra benefits with the changes in 2018 and 2019. Another example, let's take a large portfolio income or capital gain type thing. Somebody sells a significant piece of artwork. Somebody sold a significant piece in 18 of maybe some cryptocurrency, capital gains. There, the excess loss limitation would have allowed you to take that loss in addition to the over and above 250,000 or 500,000 if you're married. So now there's this potential refund there sitting there on those taxes you paid on that gain or interest income or whatever it is. And then finally is another example, just in being tax controversy people, think of your current examinations that are going on or potential amended returns that somebody's considering filing. Recently, a hot item has been microcaptives. Maybe there's an examination that's going on to cover 17, 18. Maybe they took benefits in 19. Maybe they just received the letter 6336 saying, hey, taxpayer, we know that you just got, or we know that you have a captive. Think about doing amended returns. So now in that landscape, when you're looking at these amended returns over several years, what does that amended return now look like if there's different benefits in 18 and 19? So it's really going to add a layer of complexity for us as we're dealing with, otherwise already complex controversies. So it's just something to put your thinking hat on about when you're going back and looking at your current either controversy cases or people are doing amended returns for other reasons. That NOL provision could really complicate it. And let me see if there's any questions on NOLs, and then maybe, unless anyone else has anything, I could go forward with the extensions. Are NOLs limited to businesses? Yes, it's specific to businesses. and then does it apply to businesses only? Yes, it applies to businesses only. But if that's asking if it's limited to corporations, then no, it's for business losses. So I think those are the questions we had on the NOLs. So next, let's talk about the IRS extensions. First, I'll talk about the filing extension deadline, and then get into the relief that the IRS is giving on collections.
Cory?
Yes.
Were we going to talk? Was Robert going to talk about the quickly the retirement plan changes and charitable some individual provisions?
Okay. The individual provisions, there are several changes to the retirement plan rules. Prior to the enactment of CARES, if a person under the age of 59 and a half withdraws any amounts from a retirement plan, they are subject to a 10% penalty. During 2020, you can withdraw up to $100,000 if it's a COVID-related distribution and not be subject to the penalty. A COVID-related distribution is a distribution made where the taxpayer or his spouse or a dependent has tested positive for the SARS-CoV-2 virus or had COVID-19, or the taxpayer is suffering financial hardship because they've been quarantined, they have been furloughed, or their hours have been cut, or they've had to close their business. So the person would be subject to ordinary income tax on the amount of the distribution, but would not be subject to the 10% penalty. Also, instead of a 60-day rollover, a person who receives a $100,000 distribution would not be liable for income taxes if they repay it within 3 years. Also, there is a change to the loan provisions for retirement plans. A person prior to enactment of SARS could take a loan of up to $50,000 from his or her retirement account. Under SARS, the amount is increased to $100,000. Finally, the mandatory distribution rules are suspended during SARS. Now, for charitable contributions, for people who do not itemize deductions, for 2020, they can deduct above the line up to $300 in cash charitable contribution. People who itemize their deductions can deduct the full amount of their cash contributions up to their AGI. And first, the person would deduct the non-cash contributions up to 60% of AGI, and all cash contributions over and above that amount. And thus, people who've made large amounts of cash contributions and also contributions of property other than cash would be able to zero out their AGI to the extent that the cash contributions in excess of the 60% of non-cash contributions exceed AGI, the taxpayer can carry it over. Then do you want to address the stimulus repayment rebates?
Sure.
Okay.
Yeah, I think quickly, yes.
Okay. Individuals who file so married filing separately or hetero found can get a credit refundable of up to $1,200. Married filing joint get $2,400. Also, a credit for each dependent up to $500. The amount of the credit is phased out if you are neither a head counsel or married filing joint, to the extent the adjusted gross income exceeds $75,000, and it's reduced by 5% of the excess of that amount. So if you are neither head of household or married filing joint and don't have any dependents, you would phase out completely at $99,000. The point where it starts to phase out for head of household is $112,500, and for married filing joint, it's $150,000. To determine whether someone is getting the refund, the IRS will first look at their 2019 return, and then if the 2019 has not yet been filed, at the 2018 return. And if someone does not get a credit because they are in excess of the amounts, when they file their 2020 return, the credit will be offset by the amounts of credits they've already been received for 2018 or 2019. So if someone had income of over $100,000 in 2018 and 2019, and therefore would not be eligible for the credit if they were a married filing separately or just an individual, and if in 2020 they had under $75,000 of income, they would be eligible for the credit in 2020, file their 2020 return.
Robert?
Yes.
Quick question. If somebody has child support arrearages, are they ineligible for this? Do we know?
If someone has what?
Owes money under child support and has issues with that.
I believe that the amounts would be paid. I'm not 100% certain of whether there is going to be an offset. I know the IRS will not offset taxes owed, and other federal agencies have waived their rate to offset.
Okay. All right. I think we're getting, just so the participants know, I think this was planned for an hour. We were told that we can go as long as needed. We don't have that much more, but you will get CLE credit based on the actual time. So the fact that this goes over an hour, you will get more credit. They'll issue the certificates based on the length of time. So you'll get more credit the longer you stay on, the longer we go. All we have left to talk about, and it's interesting stuff, is what the agencies are doing, what the IRS is doing based on the issues going on, and what the state authorities, the agencies are doing. So I think Cory, take it away with respect to what the IRS is doing.
Okay, so the IRS has done several things. It started with a tweet, I think, from Secretary Mnuchin And then quickly after that, the IRS issued 2020-18, which extended the income tax filing deadlines until July 15th, as well as estimated taxes. Shortly thereafter, 2020 came out and further clarified that gift taxes would be extended as well. After that, then the IRS issued frequently asked questions that addressed a lot of the questions that taxpayers had. However, there's still well over 100 questions that have been submitted by the AICPA and other groups, and I'm sure the IRS is working on those as well. Just to flag a couple of the questions that people are asking. Well, what if there's something that's not specifically extended? Because, by the way, the FAQs do list specific forms that are extended. Well, let's say you extend the 1040. Does that also extend the 5471 that's included with the 1040? Are 3520s extended? So there's all these questions over, is this extended, is that extended? And they're still looking for guidance on those issues. So I anticipate some of the questions for the panel might be, centered around those, but we're still looking for guidance as it comes out. But the guidance has been coming out very quickly, so I anticipate those questions will be addressed. So that's on the extensions for the IRS. Do you want to go to the FTB now, Gary, or come back after I finish the rest of the IRS?
Maybe go through all the IRS stuff, and then I'll go to the California stuff. What do you think?
Sure. So the other significant IRS administrative action is they came out with the People First Initiative announcement. It was a significant announcement from a tax controversy standpoint because it basically suspended collection action for people that had IRS debts. The two primary tools of the IRS when they're collecting debts, or two of them, are liens and levies. Those are both suspended. And other things are suspended as well. A hot topic the last several years has been the passport revocations, or certifying seriously delinquent taxes and then having the State Department revoke passports. Those are suspended. So basically, collection actions are suspended, except there's a sentence in there in the People First Initiative that said, and it's talking about high-income non-filers, but it says, well, collections suspended except as warranted. So that leaves open the question of, well, what's warranted? And since then, and it's out there and published, but there's been guidance for IRS executives issued by the Director of Collections of SBSC, and that gave clarity on the, what on this as warranted question. And the answer is, well, when there's exigent circumstances. And then the question is, well, what's exigent circumstances? And this isn't just limited to non-filers, by the way. And it's and then that ultimately comes down, when you look at the language, there's language in the Internal Revenue Manual for natural disasters and exigent circumstances. So when you're dealing with collection, what you're usually looking at, well, what's really serious here? Why would the IRS turn collection back on? Well, number one is going to be the statute of limitations is about to expire to collect it. That's an exigent circumstance. Another one might be if the ability to collect or the assets are being maybe dissipated or putting beyond the ability of the IRS to collect. If they see that, exigent circumstance. Now, for the high-income non-filers, there's a little bit different answer, and that's that there's not as much of a there's not the blanket suspension. They're carved out there, but still, if there's going to be a summons issued, they still need to get exigent circumstances, and the approvals for those are quite high. So we anticipate that, for the large part, that when the IRS says it's going to suspend collection action, it's going to suspend collection action. But what does that mean? And this is both regarding the extension of estimated payments and the extension of time to pay, as well as the collection issues. What the People First Initiative is looking at is relief if needed. So I would encourage us, if we have a collection issue, if the taxpayer is severely impacted, that's going to impact them and they may need relief. However, if they still have the cash flow to make the payments and the installment agreement and so forth, make them. And so if you need relief, take it. If you don't, don't. But there were a couple highlights here for the People First initiative for collection alternatives. And that's both installment agreements and offers in compromise. Oftentimes, if you're seeking an installment agreement, your client's not going to qualify because they're not currently compliant. They either didn't file some tax returns or they can't pay the current year. So now that we have this extended deadline, one, they're not going to get invalidated because they're not compliant. That's in the People First initiative, but also they have actual more time to get those payments in so that they could become compliant. So it's a real opportunity. And similarly with offer and compromises, if there's let's say they made a suspended payment offer and the offer was you make payments over time and then in 2 years you make a big payment. If you don't make those payments, you're not booted out. You didn't just disqualify your deferred offer and compromise. And similarly, if you missed an installment payment, you didn't just disqualify your installment payment. So there's significant relief there in the People First initiative. Take a look at it, and hopefully it could apply to some of your clients. Now, one last point on the People First initiative is there were some initiatives that the IRS has been really getting out there on over the last year. The 2 revenue officers visiting, high-income non-filers or high-income taxpayers and different things. As you can imagine, in-person visits aren't happening right now, but the non-filers were carved out here. So, this is relief until July 15th. You tell a client there with a tax issue, and from their perspective, it's out of their minds till July 15th. But that's not that far from now. Now, it may be extended again, but I think for either high-income taxpayers or non-filers, this is really an opportunity to get some relief while they get compliant and then go forward. And I think that's the signal they were trying to send with their non-filer high-income exception. Oh, and 2 quick highlights. Appeals is still on. They're still working their cases, and although you're not going to have an in-person hearing, so there's some strategic questions there about moving forward on those cases. And I could tell you anecdotally, that's going to depend on whether the appeals officer remotely has access to certain files and different things. So we may see some just delays, but appeals is open. The practitioner hotline is down. So that's down. The taxpayer advocate is open. So those are a couple other highlights. So I think that'll wrap up the IRS summary.
Cory, have you experienced, I've noticed in my practice that there's a lot of revenue officers still working from home. And some of the revenue officers' attitude has changed for the positive a little bit with this. And I've found that it may be an opportunity to work with while they're not coming out and doing forced collection action, this may be a time to try to resolve some issues you may have with revenue officers. I don't know if you've experienced that at all, Cory.
That's a great point, and I think that's the right tone. I've been, just emotional when and not that they aren't always people and work with you to try to get a resolution, but 9 out of 10 interactions has been, let's take a look at this and see how we can help, and then the taxpayer as representatives, it's not the time to go, haha, you can't file a lien or something. It's time to really work and see what you can do to meet them in the middle. But it's been a real, they're doing what they can too. How much can we each do with such a national disaster? They're people, and they're each trying to do what they can do, and we're trying to do what we can do. I see a couple questions. Is the IRS still accepting offers in compromise? Yes, and that is addressed in the People First initiative. And when they're in the allocation of resources, as it's you've heard from the executive guidance, to the extent revenue officers, or by the way, revenue agents or others aren't working on other things, perhaps it frees up people to work on working refund cases. And we may well see a lot of those. So there's been somewhat of a, and I'm speaking somewhat just inferring from things, but there's going to need to be a reallocation of people to focus on refunds, and yes, offers in compromise, you could still file them, and it's easier to get them and qualify because you didn't get disqualified because you're not currently compliant. Currently, not collectible cases are still being worked. That's something that's specifically mentioned, and as well as in installment agreements. And I see a question about extending June 5th. I know the second quarter question is definitely on the list of where they're looking for guidance, and because you get into this question of, well, how could you have your this quarter payment after the first quarter payment, and different things like that. So that is one of the questions. I don't have an answer yet, but different groups are looking for those answers.
And I think with respect to new offers, I think anything where a worker, an IRS employee, has to go into the office to get things may be limited. So my experience is, while we can submit offers, I'm not so sure their ability to open up a package and assign it out. My experience has been with offers that are currently in the hands of maybe a field person looking at things, or it's already in their hands and maybe they have what they need remotely, and the attitude a little bit on an offer I was working on somewhat shifted recently. And while I believed prior to this the government was being unreasonable, and I believe the offer should be accepted, once this happened and I re-engaged and we talked a little bit more, the offer was accepted recently during this whole thing. So this is a chance to go talk with your revenue officer that's already signed, go talk to your offer specialist that's already assigned, and see if there's anything worked out while things are waiting. Because I also think they have an interest of clearing these things off their desks as well. Just my take.
Yeah, great points. And just to add to that, the taxpayer advocate is open. And so to the extent that there's a submission that's made and nothing's happening, perhaps you can get some relief there as well.
And also I had a FOIA request, and I received a call from the FOIA office a couple of days ago, and they said, well, we're sorry, we're gonna have to delay because nobody can go into the office to copy the file. So those practical types of things are occurring. I think all but one service center is closed. I forget which one, and maybe it's closed now. And so anything where you think an employee needs to go into the office for something may be difficult.
Yeah, and then one last thing too, the IRS has initiated the ability to use communications and certain e-signatures in ways that they never have before. Right. So each week this thing is evolving, and they're looking for creative solutions that keep things going and get relief where it's needed. So we'll stay tuned.
Yeah. All right, I'll go quickly into the state taxing authorities, and as we all know, California has 3. So that's a joy for us to figure out what each one of them are doing. And real quickly, the FTB has conformed in essence to the IRS due dates, and so now the new due date is July 15th. They are also doing delayed collection activity. This is the Franchise Tax Board I'm talking about. They're temporarily suspending collection through July 15th, so that means no levies. They're also not doing suspensions of business entities through the Secretary of State during this time. They're also putting on suspension the top 500 delinquent taxpayer list, which many of us may or may not have clients on. And they are stopping offset of income tax refunds as well, is my understanding. With respect to installment agreements for the FTB, they're still there, but you can apparently ask for a skip. A skip is just to skip a month. And you can do that online apparently, or by phone. Also with respect to offers and compromises with the FTB, they're not going to deny anything prior to July 15th. And they're also allowing more time until July 15th to provide supporting documents if they've requested that from you guys. With respect to their audits, they say they're continuing them with modifications. They are accepting electronic signatures on things, even waivers is my understanding. They're granting extensions of time to extend, and they generally will not start a new field office is what I'm hearing. An interesting thing in the statute of limitations with respect to filing a claim for refund. If the statute of limitations for a refund claim expires between March 12th and July 15th, the refund claim will be considered timely if filed on or before July 15th. So that's an interesting statute of limitations extension with respect to refund claims. With respect to notices of proposed assessments, MPAs, there's generally a 60-day response time. If that 60-day response time falls within that same period of March 12th to July 15th, you have until July 15th to do it. So all MPAs issued after, or with the 60-day due date falls after March 12th, you have until July 15th to respond to the MPA. Notices of action, same thing. You have until July 15th to respond to the NOA. And that's quickly FTB. EDD, because they're dealing, they don't have as much out there on their audits and things because they're inundated with unemployment claims, right? So they're the agency where everybody's doing unemployment. And so what I can get from them is there's a 60-day extension to file payroll tax reports and deposits, and the deposit, do the deposit penalty. But you must request that in writing. It must be within 60 days after the due date of those things. It must be received, it actually says. I don't think a postmark rule will apply to that. And you must include a statement as to how COVID-19 will directly affect your business. So if you want to file your EDD employment tax returns late, you got to do a written request to them. And I saw there's this EDD form DE231SED that has information with respect to the EDD on what kind of relief they're giving it, some of which I just talked about. Again, that's EDD form number DE231SED. With respect to sales tax, the CDTFA, there's a 3-month extension for a tax return or payment for any business filing of a tax return if there's less than $1 million of tax. So now what it is, the returns for the first quarter of 2020, now these are sales tax returns, CDTFA, are due July 31st, 2020. All businesses have an extra 60 days to file claims for refunds as well. And there was something that came out on April 2nd, I believe, April 2nd. Businesses with less than $5 million of annual sales can take advantage of a 12-month interest-free payment plan for up to $50,000 of sales and use tax liability. It can be requested online. It requires 12 monthly equal payments. The first payment, I believe, is due July 31st. Again, so this is sales tax. If your client owes up to $50,000, there's this 12-month payment kind of automatic program. You have to request it, but I believe it'll be granted. Anybody doing anything with the Office of Tax Appeals, that's the relatively new organization where you go to these administrative law judges for appeals. They've pushed most of their deadlines out 60 days automatically, so look to that. I know we had a petition for rehearing due on Monday for the OTA decision we got recently, and I had not realized they gave a 60-day extension, so we scrambled to get this petition out Monday, and we did that. But so there is relief in all the state agencies. Most of their stuff is online. You can check it out. And that's that.
Gary,
Yeah.
Did you mention the CDTFA temporary suspension of direct debit installment agreements?
I did not.
Yeah, I have a client who's on a direct debit installment and got a form letter from the California Department of Tax and Fee Administration that all direct debit installment agreements are being suspended until June 22nd, though taxpayers who are able to make payments during that period are encouraged to do so.
Well, that's nice of them, huh? That's good. Again, I think this stuff is changing all the time. Every day we're all getting inundated on our inboxes with new things. So I think, stay current and read all the stuff that comes in from these agencies.
Yeah, one quick point on the FTB, and this was just a today thing, so it's anecdotal, but they're looking at, sure, there's relief on doing the protest or the appeal, and but maybe if they didn't issue either the notice of tax due for them to start collecting, or the NPA or the NOA, they're looking at just thinking about situations where they may just hold that until July. So I think they're looking for ways that they could help internally, and they have a team working on that. So it's kind of like the feeling with IRS when you're talking to the people. They're in there trying to help too.
All right. Any Any final comments, Robert?
No.
No. Cory?
No, just hang in there, and this is a daily thing here. So just keep looking at the FAQs on FTB and IRS.
Yeah, and
Oh, one thing, the ABA recently sent a letter to Commissioner Reddick suggesting that other filing deadline be extended under 7508A, and whether the IRS will do so, we do not know.
All right. Everybody stay safe. Have a, if you're celebrating Passover, have a nice Passover and have a good Easter, and stay well.
Thank you.
Thank you.